In 2025, Arizona's sun-drenched real estate dream is starting to unravel. After years of explosive growth, where home prices in some cities soared over 70% and median values crossed $500,000, reality is hitting hard. Mortgage rates above 6.75% have turned $1,800 payments into $3,200 burdens, and once hot markets are cooling fast. Across the state, inventory is rising, price cuts are piling up, and sellers are offering $25,000 incentives just to close deals. From Phoenix's sprawling metro to mountain towns like Sholo, cracks are forming in the desert gold rush. Here are the 10 Arizona cities where home prices are slipping the fastest. Number 10. Casa Grande. Casa Grande, once a sleepy town between Phoenix and Tucson, has seen home prices surge over the last few years, but cracks in the market are beginning to show. Back in 2019, the median home price here hovered around $180,000. By 2022, it had ballooned to nearly $325,000, a whopping 80% increase in just 3 years. As of 2025, however, that momentum is cooling. The current median listing price in Casa Grande sits around $305,000, down roughly $20,000 from its peak. With inventory levels climbing, up over 18% from the previous year, and days on market stretching to an average of 65 days, sellers are beginning to sweat. Casa Grande's affordability once attracted remote workers and retirees fleeing the higher prices of Phoenix and Tucson. But with interest rates hovering around 6.75%, the cost of borrowing has sharply reduced buyer enthusiasm. A 30-year fixed mortgage on a $305,000 home now comes with a monthly payment of approximately $2,375, including taxes and insurance, compared to just $1,275 back when rates were 3%. That extra $1,100 per month is squeezing out many of the first-time buyers and cash-strapped families that once fueled this town's growth. Meanwhile, the housing stock has expanded faster than demand. Several new subdivisions were approved between 2020 and 2023, bringing thousands of new homes online. This flood of supply, without matching demand, has put downward pressure on home values. Over 42% of listings in early 2025 have seen price cuts, with some reductions as high as $25,000. Builders are also offering incentives, up to $15,000 in closing cost coverage or free appliance upgrades to move stagnant inventory. Rental yields are also softening. The average rent for a 3-bedroom home, once peaking near $1,850 per month, has slipped to around $1,700. That's a 9% drop year over year, making investment less attractive. With inventory up, prices down, and affordability stretched, Casa Grande's market dynamics are signaling a shift in buyer leverage and overall pricing stability. Number 9. Surprise. Surprise, a fast-growing suburb of Phoenix, was once the darling of remote workers and young families looking for space, sunshine, and value. From 2020 to 2022, home prices in Surprise shot up by nearly 50%, with the median home price rising from around $260,000 to a staggering $390,000. In 2025, however, that heat is fading. The current median listing price in Surprise is hovering near $370,000, reflecting a modest but notable 5% decline from the peak. Homes are now spending an average of 58 days on the market, compared to just 21 days during the 2021 buying frenzy. Inventory has also surged by 21% year over year, which is pressuring sellers to offer price cuts. Nearly 39% of listings have undergone reductions, with typical markdowns ranging between $15,000 to $30,000. While Surprise still boasts a modern housing stock and sprawling master-planned communities, the oversaturation of similar properties is making it harder for sellers to command top dollar. The cost of financing is another hurdle. With mortgage rates averaging 6.7%, a $370,000 home now comes with a monthly payment close to $2,875, including taxes and insurance. That's up from just $1,950 a few years ago, adding nearly $11,000 in extra annual cost for the same home. This sharp rise has locked out many potential buyers, especially as wage growth hasn't kept pace. Even rental dynamics are cooling. The average rent for a single-family home in Surprise has dipped from $2,050 to around $1,890, an 8% year-over-year drop. Investors who once banked on strong cash flow are now recalculating as profit margins tighten. With an expanding inventory, higher cost of borrowing, and slowing demand, Surprise is shifting from a seller's market to neutral territory. Buyers now have more leverage, and that's reshaping the landscape of this once booming suburb in ways that could significantly affect home valuations in the coming months. Number 8. Goodyear. Goodyear, located just 20 miles west of downtown Phoenix, has seen dramatic growth over the past decade, but that explosive rise is now encountering headwinds. In 2020, the median home price in Goodyear was about $280,000. By mid-2023, it had surged past $430,000, marking a nearly 54% increase in just 3 years. Fast forward to 2025, and the market is cooling. The current median listing price has slipped to around $410,000, a $20,000 drop from its peak. That might not sound like much, but it signals a reversal that many investors are now watching closely. The average days on market has climbed to 60, a sharp increase from the 25-day average seen in 2022. Inventory is up nearly 23% year-over-year, and nearly 37% of active listings have undergone price reductions, some slashed by as much as $35,000. This trend is impacting both newer developments and existing neighborhoods, many of which have homes built after 2015 that now face direct competition with incentivized builder deals. For buyers relying on mortgages, the cost of entry has grown significantly. At today's 6.75% interest rate, a $410,000 home demands a monthly payment of roughly $3,125 when factoring in insurance and property tax. In contrast, that same house would have cost closer to $2,100 just 3 years ago when interest rates were under 3%. That $1,000 monthly difference, or $12,000 annually, is pricing out a large segment of Goodyear's first-time buyers. Rental prices, too, are showing signs of stagnation. The average rent for a 3-bedroom home has dropped from $2,200 to about $2,000, a 9% decline over 12 months. Meanwhile, builders are offering incentives like $20,000 toward closing costs, mortgage rate buydowns, or even free solar packages to attract hesitant buyers. As inventory swells and demand weakens, Goodyear is clearly experiencing the early tremors of a price reset. Whether that correction deepens will largely depend on macroeconomic trends, but for now, price softening is in full swing. Number 7. Prescott. Prescott, nestled in Arizona's high country, has long been a magnet for retirees and second home buyers. Between 2020 and 2022, its housing market witnessed one of the sharpest appreciation curves in the state. Median home prices skyrocketed from around $340,000 to nearly $540,000, a 59% surge that outpaced wage growth and stretched affordability. By mid-2025, that upward trajectory has begun to plateau. The current median home price in Prescott now floats around $515,000, signaling a roughly 5% pullback from the peak. Inventory in Prescott has risen by 25% compared to last year, and average days on market have expanded to 73, up from just 32 days in 2021. Nearly 41% of all active listings have seen price reductions, with average markdowns in the $20,000 to $50,000 range. Homes that once fetched multiple offers are now seeing fewer showings, and buyers are becoming increasingly selective. At a 6.75% mortgage rate, financing a $515,000 home today costs nearly $3,825 per month, including taxes and insurance. That's a substantial leap from 2020, when the same home at a 3% rate would have required a $2,400 monthly payment. This $1,425 monthly increase translates to an additional $17,100 per year, crippling for many middle-income families. Rental prices are also showing softness. The average rent for a two-bedroom unit has declined from $1,800 to $1,650, a 8% year-over-year drop. Investors expecting consistent rental appreciation are facing tighter margins as demand cools and affordability constraints spread. Prescott's reliance on cash-rich buyers and retirees has helped cushion some of the blow, but even that demographic is feeling the sting of higher borrowing costs and a softening investment environment. The influx of new construction on the outskirts is adding supply pressure, while economic uncertainty is making buyers wait instead of act. These factors are contributing to a noticeable market recalibration in this scenic but increasingly expensive mountain city. Number 6. Nogales. Nogales, sitting right on the US-Mexico border in southern Arizona, has always had a unique real estate rhythm compared to the rest of the state. Known for its strong Hispanic cultural roots and proximity to international trade routes, Nogales saw a steady yet modest housing surge from 2020 to 2022. The median home price rose from roughly $140,000 to $190,000, about a 36% increase in just 2 years. But 2025 is shaping up very differently. Today, that median price is hovering around $180,000, indicating a 5% year-over-year decline and signaling the early stages of a possible market correction. Inventory has increased nearly 28% year-over-year, and homes are now sitting on the market for an average of 82 days, compared to just 41 days in 2021. That doubling of listing time points to weakening demand. Over 44% of listed homes have had price reductions, some by as much as $20,000. The affordability that once made Nogales attractive is being eroded by rising mortgage rates. A $180,000 home at today's 6.75% interest rate now costs about $1,450 per month to finance, up from $950 just a few years ago when interest rates were closer to 3%. Rents are also declining. The average rent for a two-bedroom unit has dropped from $1,150 to around $1,025, down roughly 11%. Many investors who banked on stable rental income are now facing smaller margins and longer vacancy periods. Meanwhile, wage growth in Nogales hasn't kept pace with housing inflation, making it even harder for local residents to qualify for home loans or keep up with rising costs. Nogales is also seeing an outflow of younger residents heading to Tucson or Phoenix for better job prospects, creating additional drag on housing demand. As inventory grows, affordability tightens, and demand slows. This border city is showing clear signs of pricing instability, especially in lower-income neighborhoods where any price fluctuation has an outsized impact on local buyers and sellers. Number 5. Flagstaff. Flagstaff has long been one of Arizona's most desirable mountain cities. Its cool climate, access to Northern Arizona University, and stunning natural surroundings made it a prime target for out-of-state buyers and investors. Between 2019 and 2022, Flagstaff's median home price skyrocketed from $360,000 to over $610,000, an astonishing 69% jump. But the rapid growth has hit a ceiling. As of 2025, that median price has dipped to around $585,000, reflecting a nearly 4% drop in just 1 year. Inventory in Flagstaff has surged by over 30% year-over-year, with new listings flooding the market, especially in the $500,000 to $700,000 range. Homes are now sitting on the market for an average of 76 days, nearly double the 38-day average seen during the pandemic boom. Price reductions are widespread. Roughly 42% of listings have seen cuts between $25,000 and $50,000. Higher mortgage rates are hitting this high-price market particularly hard. At 6.75%, a $585,000 home now comes with a monthly payment near $4,300, including insurance and taxes. Just 3 years ago, that payment would have been about $2,900, a $1,400 monthly difference, or an additional $16,800 annually. That kind of increase is forcing many would-be buyers to exit the market entirely. The rental scene isn't faring much better. Average rents for a 3-bedroom home have declined from $2,650 to around $2,400, down nearly 10%. With a large student population, demand fluctuates seasonally, but vacancies are growing as affordability concerns spread across all demographics. New housing developments on Flagstaff's outskirts are also struggling to attract buyers, even with builder incentives like $20,000 in closing cost coverage or mortgage rate buydowns. With high prices, elevated interest rates, and a limited pool of qualified buyers, Flagstaff's market is teetering, especially in the upper middle tier price ranges that once drove its growth. Number 4. Yuma. Yuma, located in the southwest corner of Arizona, near the California and Mexico borders, has always been known for affordability. In 2020, the median home price in Yuma was around $180,000. By 2023, prices climbed to nearly $270,000, a 50% surge that reflected pandemic-era demand from retirees and military families stationed at the Marine Corps Air Station. However, by 2025, the tide is turning. The median home price has dropped to roughly $255,000, marking a 6% year-over-year decline. One key factor: inventory has spiked by 29% over the past 12 months. Yuma currently has an average of 88 days on market per home, up from 39 days during the peak housing rush. Over 45% of homes for sale have seen price reductions, with discounts often ranging from $10,000 to $25,000. These cuts reflect increasing seller anxiety in a cooling market where buyer activity is noticeably sluggish. Affordability is becoming an issue despite lower baseline prices. A $255,000 home at a 6.75% interest rate now carries a mortgage payment of around $2,000 per month. Back in 2021, with 3% rates, the same home cost only about $1,150 per month, a nearly $850 increase, or over $10,000 more annually. That extra cost is a significant burden for Yuma's median household income, which hovers near $50,000. Rental demand is also softening. The average rent for a 3-bedroom home has dropped from $1,625 to about $1,475, a 9% decrease. Investors who once saw Yuma as a dependable cash flow market are now facing shrinking returns. Meanwhile, new construction on Yuma's edge, especially in areas like the foothills, is adding to supply pressures. Builders are offering incentives like $15,000 toward closing costs, but even that hasn't reversed slowing sales. Yuma's market remains vulnerable to further price adjustments as higher rates, weaker demand, and rising inventory reshape buyer expectations. Number 3. Mesa. Mesa, one of Arizona's largest cities and a central part of the sprawling Phoenix metro area, experienced rapid real estate acceleration during the pandemic boom. From 2020 to 2022, the median home price surged from about $275,000 to nearly $465,000, an astounding 69% leap in just 2 years. But that momentum has since cooled. As of 2025, the median price has edged down to around $440,000, a 5% year-over-year decline that hints at deeper market softening. Inventory is up approximately 26% from last year, with hundreds of new listings added each month. Homes are sitting longer. Average days on market now stands at 62, compared to just 24 days in 2021. Price reductions are also rampant, with over 43% of listings cut by $15,000 to $40,000. Builders in East Mesa and desert uplands are throwing in incentives like free solar systems or $25,000 in closing costs to keep deals alive. Mortgage rates are weighing heavily on buyer activity. At 6.75%, a $440,000 home comes with a monthly payment of about $3,325, up from just $2,000 when rates were 3%. That $1,300 monthly difference, $15,600 per year, is deterring many buyers, especially first-timers. The rental market is also under pressure. The average rent for a 3-bedroom single-family home has dropped from $2,150 to about $1,950, a 9% decline. Vacancy rates have crept up, and investors are trimming asking rents to avoid long listing times. Mesa's east side developments like Eastmark, which once commanded a premium, are now facing stiff competition from newer homes in nearby suburbs. Job growth has slowed, particularly in construction and tech, weakening local demand. With surging inventory, buyer fatigue, and affordability slipping further out of reach, Mesa is experiencing a noticeable shift that is slowly dragging down property values across the board. Number 2. Sholo. Sholo, a mountain town in eastern Arizona known for its pine forests and cooler climate, saw a real estate renaissance during the remote work boom. Between 2020 and 2022, the median home price jumped from around $220,000 to $360,000, an incredible 63% increase driven by retirees, vacation home seekers, and Phoenix residents looking for affordable second homes. But now, in 2025, that surge is reversing. Home prices have fallen to about $340,000, reflecting a 6% year-over-year drop. Inventory has climbed by more than 30%, and homes are sitting on the market an average of 86 days, up from just 34 days during the pandemic frenzy. Over 48% of current listings have seen price cuts, often slashing $20,000 to $35,000 from original asking prices. The seasonal nature of Sholo's market also contributes to volatility, with slower sales during off-peak months dragging down momentum. Financing a $340,000 home at today's 6.75% interest rate now costs about $2,575 per month, up from just $1,540 when rates were at 3%. That's a $1,035 monthly increase, adding over $12,000 annually to the cost of ownership. For a town with a median household income under $50,000, this payment level is out of reach for many locals. Rental yields are shrinking too. The average rent for a 3-bedroom cabin-style home has dropped from $1,950 to around $1,725, a decline of 11%. Investors who bought at peak prices expecting strong rental demand are finding the off-season especially challenging, with increased vacancy and lowered rates cutting into profitability. Meanwhile, new cabins and custom homes built during the boom are hitting the market, creating a wave of competition. Builders are offering steep discounts or special terms, like rate buydowns and appliance packages, to unload unsold inventory. Sholo's mountain charm remains, but its housing market is cooling quickly as affordability wanes and speculative demand fades. Number 1. Phoenix Metro. The Phoenix metro area, once one of the hottest housing markets in the U.S., is undergoing a dramatic slowdown in 2025. From 2020 to mid-2022, median home prices in the metro area climbed from $295,000 to over $510,000. A jaw-dropping increase, 73% increase. But now, prices have fallen to an average of $485,000, reflecting a 5% dip year over year, with some neighborhoods like Buckeye, Levine, and Maricopa seeing declines of up to 8 to 10%. Inventory has surged by over 35% compared to last year. Homes are taking longer to sell. Average days on market now exceed 64, compared to just 18 in 2021. More than 45% of listings have been reduced, with some sellers slashing $40,000 to $75,000 from their original price tags to attract hesitant buyers. At the current 6.75% mortgage rate, financing a $485,000 home now costs around $3,625 per month, including taxes and insurance. That's nearly $1,500, more than the same home would have cost monthly just a few years ago when interest rates hovered at 3%. That $18,000 annual difference is pushing many would-be buyers out of the market. Rents across the Phoenix metro have also cooled. The average rent for a 3-bedroom home has dipped from $2,300 to around $2,100, a 9% decline. Investors who bought at peak prices are feeling squeezed, especially in high construction areas like Queen Creek and Surprise, where vacancies are increasing. Several large-scale developments approved during the boom are now adding thousands of new homes to a softening market, further pressuring prices. Builders are offering massive incentives, some up to $30,000 in discounts, mortgage buydowns, and even rate locks at 5.5% to keep volume moving. But with demand waning and affordability strained, Phoenix is entering a clear correction phase. The balance of power is shifting toward buyers, and that dynamic is already visible in falling prices and increased market competition.